This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 7 videos on protective stops. I want to talk a little bit about wide stops in this video. We have a bull trend here and a breakout of a bull flag here, possibly an exhaustive end of the move. We have a big bear bar closing on its low, but then we have a 2-bar reversal, down, up, and a good-looking bull signal bar. It's a high one buy. Chances are we'll go up at least a little bit higher after this strong bull breakout, despite this attempt to reverse. If you take this buy above the high of this bar, you get filled here. You could put your stop right below the bottom of the bar, but the 2 consecutive bear bars, that could lead to a second or third leg down. So 1, pullback, 2, pullback, 3. For example, a wedge bull flag, wedge high or low. If you're taking this buy, it's probably better to use a wider stop, either here or even better here. Why here instead of this? It's a buy climax. It could be an exhaustive end of the move, and its low is a magnet. However, if the market falls below the low of this bar, probably some buyers. If it falls below the low of the entire bull leg, probably the bull trend has ended. Some traders prefer to use a wide stop to have a higher probability of success. In general, a small stop means small risk, and it means a very good risk-reward ratio. A good risk-reward ratio always means low probability of success. You lose most of the time. Some traders want a high probability of success, and a good way to do that is increase your risk. Use a wider stop. Another way to do it is increase your reward. For example, go for a reward equal to 2 times your risk or more. The market's pulling back from the high. We got the second leg up, first leg pullback, second leg. It could get a third, fourth leg up, but we're starting to pull back here. 1 leg down, 2 legs down, 3 legs down. If you want, you can call it a wedge. You can call it a high 2, high 1, high 2. The bulls have a breakout above the top of this small channel, the wedge bull flag, but it immediately reversed. Once you have a big bear bar closing below the low of the wedge, followed by a second bear bar closing on its low, you're probably going to get a measured move down, a failed breakout below the bottom of the wedge. That would be the minimum objective. At this point, you have 6 consecutive bear bars, 4 closing on their lows. This is a give-up set of bars. The bulls are giving up, and the bears are selling aggressively. The odds are the result will be at least a measured move down. It's a sell-to-close market. A lot of traders will wait for the breakout bar and wait to see if there's one more bear bar closing near its low, and then they'll sell the close. If you're a bull and you bought here and you did not exit here, I would recommend exiting on the follow-through bar after the bear breakout, and don't wait for your stop to be hit. You have a wide stop, but the premise has changed. Instead of a bull trend, the market now is always in short. It's probably going to fall for a measured move down, which means it'll hit this and probably this stop as well. Not only should the bulls exit here, and this is a sign that they did exit, consecutive bear bars breaking below a wedge bull flag, bears will sell that close as well, and they'll sell low 1 and low 2 bear flags. For example, we rallied up here. Traders will sell below the low of this bar, and they'll get filled on the bottom of this bar. And now they have a low 2 short with a bear sell signal bar. They'll sell here as well. Their stop will be above the top of the bear reversal, this bear breakout. The market rallied. We have a strong leg up and a second leg up, possibly a trading range, possibly a second leg trap. It's also an expanding triangle, 1, 2, 3, 4, 5, with a good bear bar. Bears will sell on the reversal down below that low. You can also draw a channel here, and you can say the market's reversing down from the top of a channel. In this particular setup, a price action stop, you'd put it right above the top of this bear reversal bar. 2 legs up in a triangle, a good-looking bear bar, top of a channel, expanding triangle. If the market goes above the high of this bar, it's probably better to exit because your premise of a triangle top is probably wrong. Reasonable to put a price action stop, a stop based upon the price action, above the top of a strong sell signal bar with a reasonably good sell setup. Most likely, the market will remain in a trading range, but you might get a swing down, and it should not get above the high of this bar. If it does get above the high of this bar and reverses down again, traders will stop themselves out and then sell again on the second reversal down. To allow for that possibility, some traders will sell below the low of this bar and they'll get filled here, but they'll use a wider stop, maybe based upon a measured move based upon the height of this bar. Maybe they'll put their stop here, 2 times the height of the signal bar. Some traders like to use money stops, like a fixed number of ticks or a fixed number of pips from your entry price. Maybe 10 ticks, maybe 20 ticks from the entry price, maybe 10 pips, maybe 20 pips from the entry price. If this were a daily chart or a 60-minute chart, they would use many more pips. Let's say you sold below the low of this bear reversal bar, given expanding triangle, top of the channel, and you did not want to risk to above its high. Instead, you might want to risk to just above the midpoint, or you might want to risk exactly 10 ticks or 10 pips. Reasonable choice, but I think a better choice is a stop above the top of the sell signal bar, which is just a little bit higher. You might, in fact, want a stop above the high of this bar, and maybe you're a person who always uses a money stop, a multiple of some minimum, like 10 ticks or 10 pips, in which case 10 ticks or pips is not enough because it's not above the top of the bar, but 20 ticks or pips is enough. The market has a number of good bear bars, good selling pressure, and it's trying to reverse down. If the market gets above the high of this bar, what's more likely? A strong breakout and a new bull trend, or a failed breakout and a reversal down? Probably a reversal down. They sold above the high of this bar, and it came back below the breakout point. They sold above the high of this bar, it came back below the breakout point. They sold at the high of this bar, probably is going to come back below the breakout point. If it gets above the high of this bar, what do you think is going to happen? Traders will sell it, and it will come back down far enough for the bears to make a scalp. And therefore, if the market goes above this bar, chances are there are sellers above. If it goes far above, the bulls will probably win. You'll probably get a measured move up. Some traders know that it could easily go above the high of this bar, but still reverse down again, and those traders allow for that by using a wider stop, either a money stop or a stop based upon the price action, a price action stop. A lot of traders don't worry about picking the exact top. When you pick the exact top, you have to be totally prepared to sell at the exact instant. And some traders are slow to decide, or they tend to do other things while they're working. They're not watching at the instant the market reverses down. They also don't want to worry too much about the market maybe going another leg or two higher. They're just getting confident that the market will go down soon. They'll sell, and they don't want to worry that the market may go a little bit above the top of their sell signal bar. They're confident that the market's going down, and therefore they want to use a wide stop. If this is not the top, they believe the top will come soon. Unless the market goes far against them and hits a very wide stop, they're confident that the market will get a reversal soon and they'll be able to make money. Whenever you are trying to get a higher probability of success, as I said, you pay for it with an increased risk. You have to use a wider stop. Also, you often will be willing to scale in higher, which additionally increases your risk. You need to keep the total risk on any trade to be no greater than on any other trade. And that means if you're using a wide stop, especially if you're willing to scale in, you have to reduce your position size so that if you get stopped out, you do not lose more than you do on any other trade. The market has been sideways for about 50 bars and now has an exceptional bear bar closing on its low, far below the low of the past 50 bars. And not only that, there's a follow-through bear bar. Probably this will lead to a measured move down. At a minimum, a 60% probability you'll get a measured move down from the open of the first bar of the breakout to the close of the final bar of the breakout. Here it's a 2-bar breakout. 60% chance it'll fall for a measured move equal to that distance before it gets above the top of the bear breakout. Traders will sell that close of the follow-through bar. Some will sell as the bear bar is forming because it's clearly bearish and falling quickly. They'll put their stop above the top of the bear leg, which is also above the top of the sell climax bar. And in this particular case, let's say it's 50 ticks if you're trading the E-mini. If it's a Forex chart, let's say it's 50 pips. For some traders, when they see a bar that is so much bigger than all the prior bars, they don't want to risk all the way to its high. They know that if the market pulls back to around 50%, a lot of bears will sell a 50% pullback. And therefore, they'll put their stop maybe 5 ticks or 5 pips above the midpoint of the sell-off. They entered here, the top is up here, this is the midpoint, so maybe they'll put their stop 5 or 10 ticks above the midpoint. They might also want to use a money stop, for example, 20 ticks or pips above the entry price. These are all reasonable stops. I think the best stop is above the top of the bear leg. And obviously, a wider stop means greater risk. Greater risk means worse risk reward. And that always is accompanied with higher probability. In general, whenever you use a wider stop, you're increasing the probability of making money. I think of the three, this is the most logical stop. But some traders do not have an account size that would allow them to use that stop. And they therefore will have to use some other stop, like just above the midpoint or maybe a fixed number of ticks or pips. 60% chance of a measured move down, 60% chance if you sell this close, it'll fall this distance before it goes that same distance up to the stop. You know where the entry price is, you know where the stop is, and therefore you can create a target equal to the distance to your stop. And there's a 60% chance that the market will get there whenever you see an exceptional breakout, good context, and a good follow-through bar. Some bears will place limit orders to take profits at 1 times risk. Whenever you take a high probability trade, the trader's equation is positive when you take a reward equal to 1 times initial risk. In fact, it's positive if you take a reward equal to 1 times actual risk. If you sold here, your actual risk is probably just somewhere up in here, certainly no greater than above this bar, and theoretically you could take a profit here. That would be the minimum acceptable, a 60% chance of reaching that target before losing that many ticks. However, in general, when I'm trading a big breakout with follow-through like this, I'm basing my target on initial risk, not actual risk. The minimum is based upon actual risk, but when you get a breakout like this, 60% chance you're going to get a measured move based upon initial risk, so you have much more potential profit. Again, the higher the probability, the worse the risk reward. Whenever the probability is high, which means 60% or more, as it is here, you can go for a smaller reward. For example, 1 times your initial risk. We have a reversal, possible final flag, trading range after a bull trend. We have a strong breakout and a strong reversal. We have a bear inside bar. Some traders will sell below the low of that bear bar, betting that the bull breakout will fail and that will get a swing down. That is a reasonable thing to do. Failed breakout above a tight trading range, and this tight trading range is probably the final bull flag in this bull trend. You can put your stop above the top of the sell signal bar. I would put it above the top of the bear trend because sometimes it'll go a tick or two above the top of the sell signal bar, but not above the top of the bear trend. And the two stops are close together. I think you get higher probability if you use the stop at the top of the bear trend, which is always the case. Whenever you use a wider stop, you have a higher probability of making money. The market's in a bear trend, a bear breakout, good follow through bar, probably some kind of a measured move down, maybe based on the height of this double top. In any case, the bears have a double top bear flag here, probably at least one more leg down, 1 pullback 2 or 1 pullback 2. Traders are starting to look for some kind of a reversal up into possibly a trading range. Here we have 2 legs down, 1 pullback 2, a failed breakout below this low. The bulls made money buying at this low. This is probably the start of a trading range, and therefore if you get a bear breakout and a reversal up, especially with a very good buy signal bar like this, traders will buy above the high of that bull bar. It's reasonable to put your stop just below the low of that bar. It's a very good looking bar. 2 legs down, 1 pullback 2, possible final flag. The bear trend itself is not especially strong. We have a tail here, a reversal here, a reversal here. This looks like a bear leg in what will become a trading range. And now we're getting a failed breakout below a low after the bulls made money buying at this low. And you have a very good looking bull bar for the signal bar. It's reasonable to put your stop just below the low. If you get stopped out and the market reverses up again, you can buy again. Minimum goal, whenever you have a reasonable bottom, is 10 bars, 2 legs, sideways, 2 up. We have consecutive sell climaxes, a little bit here, and then these bars, and then here, a little here, a little here, a little here. That increases the chances that at some point the market will have 2 legs and 10 bars sideways to up as a minimum. and you get reasonably good buying pressure. A tail here, bull bars, reversal, reversal, and now a very good looking buy signal bar. The channel is tight. The first reversal up, probably minor, a bull leg in a trading range, but it could end up being major. In this particular case, the bulls got a swing up lasting 40 or more bars. You can call this a double bottom higher low major trend reversal. You have a bear trend, a bull breakout, a tight trading range, and this would be a major reversal. This is a minor reversal. This is a minor reversal. This is a minor reversal. However, sometimes a minor reversal leads to an opposite trend, a swing trade, even though the odds are more likely that it's going to go sideways and enter a trading range. A lot of traders like to use a default size for a money stop. For example, a reasonable number of ticks or pips from the entry price, regardless of the price action. Again, a lot of traders don't worry about picking the exact top or the exact bottom, but they're pretty good at knowing that a bottom or top is going to come pretty soon. To make sure that they don't get stopped out on a minor new low here in a bear trend, they'll put a stop well below the signal bar. For example, some might use the size of an average trend bar for their stop. Other traders might use 10 to 20% of the average daily range, and they'll use a stop that far away from their entry price. It looks like we're entering a trading range. We have a bear trend, a lot of reversals, a lack of consecutive big bear trend bars. The trading range has replaced the bear trend. Traders are buying new lows. They bought below this low, below this low. In fact, they even bought below that low. And they'll certainly buy below this low. And now we're getting a reversal up. You can call it a spike and channel bear trend. Spike, pullback, second push, pullback, third push. I know it does not look like a channel, but it's basically a variation of a spike and channel trend. You could put your stop just below the low of this bear leg, or if you prefer to use a fixed number of ticks or pips, you might put your stop 10 or 20 pips or 10 or 20 ticks below the low of the bar, or about an average size of a bar, or about 10% of an average daily range. This would all be around the same general area. Your purpose is you're allowing for one more leg down, confident that when the market fell below here, they bought just a little bit below. When it fell below here, they bought just a little bit below. If it falls below here, they'll probably buy a little bit below. If it falls a lot below, then your premise is no longer valid. These traders will buy here, use the wider stop, instead of getting stopped out here and then having to re-enter on another reversal up. They would rather just buy what is reasonable, use a fairly wide stop, trusting that if it falls below this low, it will soon reverse up without hitting this stop. A lot of traders like to use a price action stop based upon a measured move. For example, we have a trading range. We have a double top, this high, that high. This is the neckline of this double top, and the bears are hoping that we'll fall for a measured move down if we break below the neckline of the double top. The bulls believe that it might fall to that measured move, but it probably will not fall much further. And therefore, if they buy here, they might put a stop just below this measured move target, betting that the bears who sold will take profits around the measured move target, and a trading range like this probably will not result in a strong bear trend. If the market does sell off, it probably will not fall much below this measured move target. And therefore, they'll put a stop just below that target, confident that if it falls down here, it will reverse up again. If they buy here, and if it does fall down here, maybe they can buy some more on a reversal up, confident that the breakout will fail and it will get back to this entry price. And then if it does, you can get out break even at this entry price, and if you bought on a reversal up, you'd make a profit on your second entry. If instead it does this, then you simply hold on to your position and ride the swing up. We have a sell climax bar here. If you want to use a measured move target to create a stop, you could argue that it's a sell climax. Maybe the market will fall for a measured move based upon the height of that bear breakout, which would be here, and then you could put your stop just below that low. The reason why traders like to use a wide stop is it gives them time to allow their premise to work. Most of the time when you're using a wide stop, you're going to exit before your stop is hit. but the stop gives the market time to work in your favor. As long as you believe your premise is still good, you can rely on your stop, trusting that you're right and that the market will go your way, but it may go a little bit against you before it does go your way. If it hits that wide stop, you will conclude that your idea is no longer valid, and therefore it's appropriate to get out of your trade. Take the loss. We have a bear trend, a head and shoulders bottom, left shoulder, head, and a right shoulder. This is a reasonable buy. Yet we're breaking below the right shoulder. Bulls exit there, and you can see that's why we got this big bear bar. We have a good looking head and shoulders bottom, a wedge higher low, down, up, down, up, down, up, a good looking buy signal bar. A lot of these bulls who buy here will put their stop just below this low. And you can see this big bear trend bar is those bulls getting stopped out. When you get a bear breakout below a head and shoulders bottom, usually better than a 50-50 chance you're going to get trend resumption down. Maybe a measured move down, maybe based upon the height of this double top, this high, that high, neckline, measured move down. Maybe based upon this double top, this high, neckline, measured move down. However, now we're getting a failed bear breakout. The bears have a breakout, but where is their follow-through bear bar? Instead of a bear bar, we got a bull inside bar. It looks like the bear breakout below the head and shoulders bottom right shoulder is failing, and the bear breakout below the low is failing. And this, instead of being a failed head and shoulders bottom, might be a wedge bottom, 3 pushes down, 1, 2, 3. You can see as soon as it fell below this low, traders bought. Sometimes you take the initial buy, you get stopped out, you get a second entry buy, higher probability, and it can go a long way. If you want, you can call this a nested wedge. 3 pushes down, 1, 2, 3, and the third leg had 3 pushes down as well, 1 or 1, and then 2 and 3. And you have a decent buy signal bar. Some of the traders who bought this higher low believe that if it fell below this low or this low, 50-50 chance it'll fall for a measured move, 50-50 chance the bear breakout will fail and reverse up. I think that's reasonable. Those traders will use a measured move for their protective stop. So if they buy above this bar, they don't want to exit at the low of this bar, thinking that it's an attempt at a bottom. Maybe the market needs one more attempt at a bottom before you get a swing up. Traders with that mindset, and it's an okay thing to do, will use a wide stop, allowing for the market to fall below this bar and even below this low, betting that if it does fall below, it'll still reverse up as it did here and here. We fell below this low, they bought. Below this low, they bought. Below this low, they bought. Below this low, they'll probably buy. So if you buy here, you can use a wider stop. Likewise, if you buy here, you could use a wider stop as well. Maybe we'll get a small second leg down after this bear breakout, but probably not much more down. If your premise of a reversal is valid, it should not fall too far down. And therefore, if you buy above here, maybe use a stop based upon a measured move down. We have the right shoulder and then the top, the neckline. Chances are the market will not fall here, or you can use a measured move based upon the height of the entire trading range. Double top, neckline, measured move down here, trusting that we have a lot of trading range price action, and any break below will reverse back up. So if you decided to use a measured move based upon the height of the right shoulder, that's the measured move, and you put your stop just below. In this video, I talked about wide stops. A lot of traders use wide stops because they do not want to worry about picking an exact top or bottom. When they use a wide stop, they have to trade small. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 7 videos on protective stops. There are many different ways to choose a protective stop. An important one is one based upon a measured move or other support and resistance. Whenever there's a small signal bar, if you put your stop just beyond that bar, your risk is small. However, whenever you have excellent risk reward, for example, when you have a very small risk, the probability of profit is very small as well. It's usually better to use at least a slightly bigger stop. Different ways to view this as a wedge. 1, 2, 3, or 1, 2, 3, or 1, 2, 3. Reasonable to take the sell. A lot of reversals, a lot of two-sided trading, and when above this high, they sold. When above this high, they sold. Above this high, they sold. Above this high, they sold. Above this high, well, they'll probably sell, especially given that there are multiple ways to draw a wedge. It's reasonable to take the short, selling below the low of this bar, and you get filled right here. A series of buy climaxes here, 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 and again here. Usually that results in a reversal at some point, and now that we have a nested wedge, this is a reasonable location to bet that the market will begin to reverse. Strong breakout, probably will get at least a second leg up. Well, this qualifies as the second leg up. Whenever I see a wedge, 1, 2, 3, I want to see the pullbacks drop below the breakout point. I want to see a stairs pattern. I do not want to see gaps staying open. If I see gaps staying open, the market's probably going to continue higher. But if the pullbacks drop below the breakout point, that's a stairs pattern. That means that the bull trend will probably soon be replaced either by a trading range or a bear trend. If you take the sell below this bar, you could put a stop just above its high. Or you could argue that the market went this high above this breakout point. Here's that same distance. It probably will not go further if it breaks out above this high. And therefore, you look at how high this is above that. You create a box here, you make the same box here, and you put a stop just above that. A measured move based upon the height of the last stair, betting that this stair will be no bigger than that stair, and that the bull trend will weaken over time. Strong rally. We tried to reverse a second time, tried to reverse a third and fourth time, and the reversals are failing. Bulls will look to buy a reversal up. It's a wedge bull flag. Plus we have a gap here in this low, possibly a measured move up. Traders will buy above the high of the prior bar. We have a breakout and a pullback. This would be another buy above the high of that bar. You get in right there. If you want, you can draw it this way as a triangle. 3 pushes down, 1, pullback, 2, pullback, 3. Triangle bull flag. We have a big breakout. We're trying to reverse up repeatedly. This is a potential measuring gap, the gap between this low and that high, the breakout point. If the premise that this is a bull trend is valid, the market at this point, once you enter here or here, it should not close this gap until after it gets up to this high. Therefore, it's reasonable if you buy above this bar, get filled here, above this bar, get filled here, to put your stop below the bottom of the gap. Here's the bottom of the gap, and stop just a little bit below. Whenever there's a strong bull trend, bulls like to buy a 50% pullback. This is a strong bull trend, reasonably strong bull trend. And this is a 50% pullback. Some traders know bulls will buy here. If it falls much below there, bulls will conclude it's not a strong bull trend. It's either a trading range, maybe even a bear trend. A strong breakout here. Here's the 50% pullback. Let's say you bought at the absolute worst price right here. The bull trend is strong. Probably the worst the bears will get is a trading range instead of a bear trend after such a strong rally. And the same is true here. The reversal probably will be minor, either a bull flag or a trading range. In this case, it did reverse into a trading range. A trading range means that if it does fall even below 50%, it probably will not fall below the low before it gets back up to the high. Because of that, some traders will put their stop just below a 50% pullback. Here's the rally, here's a 50% pullback. Some traders will put their stop just below the low of the 50% pullback. Here, a 50% pullback, the bottom of the trend, the top of the trend. Even if you bought at this high tick, you could reasonably put your stop below a 50% pullback. Better to put it down below the bottom of the bull leg. But if you put it at the 50% pullback and you get stopped out here, you can always buy on a reversal back up, either above here, above this bull bar closing on its high, or above this bull bar closing on its high. If you get stopped out and the market again reverses in your direction, you can buy again. You can call this a triple bottom, a head and shoulders bottom, left shoulder, head, right shoulder. You can call it a wedge, even though this did not fall below that. In any case, the bears 3 times tried to get a swing down and they failed. And the market's reversing up. And it has a decent buy signal bar here. It's reasonable to buy above this bar, and you get filled on this bar. If you're lucky and we break above the top of the double top, the market will probably rally to a measured move up, which turns out is at the top of this bear leg. If you buy, you might want to use a wider stop, thinking that, well, if you bought here, it fell below that low. If you buy here, it fell below this low. Maybe if you buy here, maybe it'll get another small leg or 2 down. But it should not fall for a measured move down if your premise of a rally coming soon is valid. If it does fall below this low, then probably the market's in a continued bear trend, and your thought that it's going to reverse is wrong. And therefore, it's reasonable to put a stop down here, because if it falls below that measured move target, your belief is wrong, and you should be no longer holding a long trade. Some traders will use an extreme stop, the height of the bear leg, and put a stop down here, looking to scale in lower if it does fall down here and starts to reverse up. Is that a bad thing to do? No, most of the bears who do use a wide stop like this or like this are never going to let the stop be hit. If there's a strong bear breakout with good follow-through, they'll get out on the close of the follow-through bar well above their stop. This stop is a catastrophic stop. If you lose power, if an emergency happens and you have to leave, if there's a problem with your broker, a problem with your software, anything, the wide stop will contain your losses, but give you time to have the trade go in your direction. Here's a 5-minute chart, and here's the 60-minute version of this entire 5-minute chart. These bars are exactly these bars, the 60-minute chart, the 5-minute chart. We have a wedge top, 1, 2, 3. Also, you can call it a bigger wedge, 1, 2, 3. A decent sell signal bar. Reasonable to take that short, betting on a double top in a trading range. Again, different ways to draw the wedge top. Different computers see it differently. Another way to draw it, but reasonable to sell here, reasonable to sell there. Some traders who take this short are not confident that it's the final top, but they are confident that if it's not, the market will top out pretty soon. They sold above this bar and made money. They sold above here and went down. Above here and went down. Above here, it probably will go down again. And a lot of the bears who took this sell want to allow for the possibility that it might go above the high, but immediately reverse down. They'll use a measured move, for example, for their stop. We have a double bottom bull flag, a neckline. Here's the measured move up. So they might put a stop just a little bit above that. Again, they're never going to let that stop be hit, or they'll rarely ever let it be hit. However, if it does hit that stop, they know their premise is wrong, and they should be out, and they should take the loss. They're using the wide stop because they're confident that the premise is right. If they do sell here and it goes above the high of this bar, they're confident that there'll be sellers there, and the market will eventually go down. And they don't want to sell here and get stopped out and then miss the trade. This red box is exactly this red box. If you were looking at the 60-minute chart when you took this short, you would be shorting right here. You can think of a wide stop, like here, as an ordinary stop on the 60-minute chart. On the 60-minute chart, if you were to sell below the low of this bear bar, reversal down, 3 pushes up, you'd be filled right here. And that would be here on the 5-minute chart. This price on the 60-minute chart, if you took that short on the 60-minute chart below this bear reversal, and then you looked at the 5-minute chart, this is where you'd be filled. If you took that short, you would put your stop above the top of the bear trend, just above this high. Had you looked at the 5-minute chart, your stop would have been here, at the top of the sell-off. And that's reasonable. It's a tight bear channel. Probably the first reversal up, bears will sell it, bulls will sell it as well. The bulls who buy will be buying only for a scalp. The bulls who were long will use any rally to get out with a smaller loss. Therefore, the stop should not be hit on the first reversal up. I think it's important to realize that if you have a small signal bar and you put a stop just beyond it, your risk is small. But whenever you have small risk, you're probably going to lose money. You have a small probability of success, and therefore a very tight stop is rarely ever a good thing to use. Here we have a bull trend, and we have another breakout to new high. This is a reasonable high one buy. However, let's say the signal bar is only 3 pips tall or 3 ticks tall. If you put your stop just below it, then you're risking about 5 pips or 5 ticks. You buy 1 tick above, 1 pip above, you stop as 1 tick or 1 pip below, your risk is 5 ticks or 5 pips. And that's small, especially compared to the size of the leg before it. Whenever you have a very small stop, that means you have excellent risk reward. Small risk, big reward. It also means that you have low probability. If you have a low probability of success, you have a high probability of losing money. It's rarely ever a good idea to put your stop below the bottom of a very small signal bar. Instead, it's better to look to the left, look for the most recent strong rally, and put your stop below the bottom of that most recent strong rally. If it's a bull trend, it should not fall here before going up far enough to make a profit. There are many different alternatives for a wider stop. The point is, if you have a very small signal bar, do not use the low of the bar for your stop, because the risk is too small. That automatically tells you that the probability of making money is low. In other words, you'll probably lose money. Some traders will use the appropriate stop. They'll buy here, trade small, and then when you get a second entry, they'll buy more here or above this bull bar. Using that wide stop allows them to buy more if they want to buy more. It also allows the market to go a little bit further against them. They can hold on to the position, and then the trade ultimately is profitable. We have a trading range and a breakout, possibly a failed breakout. Some traders will sell the reversal down below that bar, that inside bar. They'll sell on a stop below its low, and they'll get filled right here. Let's say the bar is 3 pips tall. Then if you sell 1 pip below, your stop is 1 pip above, your risk is 5 pips, very small. Why will you probably lose money? If your risk is small, your risk-reward ratio is excellent, and whenever you have an excellent risk-reward ratio, you have low probability of making money. That means that most of the time you'll get stopped out and you'll lose money. Whenever you have a very small sell signal bar like this, it's a mistake to put your stop just above the high of the bar. You need a wider stop to improve your probability. You could use a money stop like 10 or 20 pips above, or you could use a stop based upon a measured move. The key is to trade small, and you can always add on if the market goes your way. The market went above the high of the sell signal bar, and then it started to reverse down again, maybe a wedge, higher high, major trend reversal. Some bears who sold here, used the wide stop, did not get stopped out, might sell more here, betting on a second entry short, failed breakout above a trading range. That is a higher probability short than is this. Second entry trades are usually higher probability. Strong bull breakout. It's a high one bull flag. It's a small buy signal bar. Probably better not to put a stop just below its low, although it would not get hit here. Instead, put your stop below the bottom of the most recent strong bull breakout. A wider stop means higher probability of success. A wider stop is greater risk. Greater risk means worse risk reward. Bad risk reward means higher probability of success. Too small a stop, the risk is too small. The probability of winning is too small. This is a daily chart. If you don't want to trade small positions on the daily chart, one alternative is to use options to express your opinion. Let's say you look at the chart at this point and you say, wow, that's a pretty good bear breakout. Very tight channel, probably going lower. And you look at the chart and say, wow, this is a daily chart. My stop is up here 15 days higher. That's just too much to risk. Instead of selling here and putting your stop up there, an alternative is to buy puts or buy a put spread. I talk about this more in the videos on options trading. If this were a stock, traders would call that a stock replacement strategy. For example, let's say you're short the stock and now your stop is very far away and you want to stay short, you believe the market's going lower, but you do not want that much risk. An alternative is to buy back your short so that you're flat and then go ahead and replace your short position with either long puts or a put spread. So you buy puts or you buy a put spread. Your risk is contained and smaller, and you're still able to hold on for a swing down if the swing down continues. What about something more complicated? Some other complicated option strategy? Not worth it. 90% of the time, trading simply a call or a put or a call spread or a put spread is a very good choice. We got a pretty good bull trend here. And therefore, you can buy for any reason. You can buy below a bar, betting the reversal will fail. You can buy above a bar, a high 2 buy. We got a breakout of a high 2 bull flag, a pullback, a breakout of the pullback. And then here, another breakout of a small bull flag. It doesn't matter why you buy. Here, we have a pullback that did not fall below this high. We have the potential for a measured move up from down here or here to this gap up here. If you're trading, if you're buying for any reason in here, the important thing to do is use a reasonable stop. You don't want it to be too small because, as I said, small stop means small risk. Small risk means you'll probably lose money. It's a low probability of success. And should you use a stop all the way down here if you buy here? Well, that could be much bigger than what you're comfortable risking. That could be unreasonable as well. You're always making trade-offs among the variables in the trader's equation. When you have a strong breakout like this or like this, the probability is high that the market's going higher. Whenever the probability is high, you always are going to have a bad risk-reward ratio. That usually means that the stop is far away. If you buy here, the stop is far away, and you're buying late, and therefore there's less reward remaining in the trade. High probability, buying a strong breakout like this, usually means bad risk-reward. That's the trade-off. Whenever you're taking a trade, because it has high probability, you pay for that high probability with bad risk-reward. Let's say you bought anywhere in here. One choice would be putting a stop below the bottom of the gap, betting that the gap will remain open. Obviously, the best stop is here, but for some traders, that's too much to risk, and therefore they need a tighter stop. One choice is right below the high of the breakout bar, betting that maybe we'll get a measured move up. You could also put your stop below the low of this breakout bar, or even below the low of this bar. I would not put it below this bar. It's so close to the bottom of the bull trend, I would instead put it here instead of here. But these are other reasonable choices. You could put your stop all the way down at the bottom of the bull trend down here or here. However, after 50 or 60 bars rallying, most traders would not use a stop that wide. They would use a tighter stop. Beginners often make the mistake of pretending that the risk they're exposing themselves to is really not as risky as they think. For example, let's say you buy a high 1 bull flag or a high 2 bull flag here. And you put your stop below the bottom of the bull trend. That is an appropriate location for the stop. If you're a beginner, you take that trade and you put your stop down here knowing it's the right place for the stop. Most beginners will panic and say, oh my gosh, I never thought it would get down here. I really did not intend to risk that much. They knew it was the right place for the stop, but they never were willing to hold onto their positions and rely on that stop. Whenever you're entering late in a trend, far above the most reasonable stop, your risk is great, and you have to trade small because you have to remain within your comfort zone, and you have to make sure that you are not risking any more on this trade than you would on any other trade. There's always a possibility that before we get a second leg up, we'll get a very deep pullback, and instead of this being the start of a bull trend, it might be a bull leg and what would end up being a trading range. If you buy up here for any reason, the correct stop is down here. If it falls below this low, your premise of a bull trend is probably not valid. However, instead of a bull trend, it could be a trading range, and fall very far down, not hit your stop, and if that's true and it is a trading range, it'll probably come back up to your original entry price. Had you bought here and you bought more, maybe above a bull bar here, you could hold on for the market to come back to your entry price, get out break even on your first entry, and with a profit on your lower entry. The point is, whenever you take a trade and you see the obvious stop, you rely on that stop. If you cannot risk that much, do not take the trade. Even though the market pulled back very deeply, I think most traders would see it as still always in long. We had a pair of bear bars here, but possibly a wedge bull flag, a bear channel bull flag. For the rest of it, it never had consecutive big bear trend bars, and therefore it's probably still a bull flag. It's probably a bear leg in a trading range and not the start of a bear trend. If it's a trading range and it sells off, it probably will rally again and get back up to the top of the range. Many traders who bought here, if they see 3 bear bars closing below their midpoints or on their lows, will just exit, and that's reasonable, and then they can buy again on a reversal up. It's okay to hold on, betting that the market will not fall below the bottom of the bull trend, and you can add on lower. A lot of bulls will exit, and when the bears see 3 consecutive bear bars closing on or near their lows, they'll sell. Here's a high one buy, 3 bars down, a pullback, 3 bear bars, probably sellers above. So traders will sell this close, and they'll sell at the high of this bar, betting that it's a bad buy signal, and therefore probably sellers above, and at least a small second leg down. We have a spike down, a breakout, and then 3 pushes down, 1, 2, 3, or 4. It's a spike and channel, wedge, bottom. Most importantly, it's a higher low. It never clearly became always in short. If you relied on your stop and managed your trade correctly, you could buy again on the reversal up above this bull bar or this bull bar or this bull bar, get filled here, and the market will come back to your original entry price. You get out break even on your first entry and with a profit on your lower entry. Sometimes when you have a wide stop, it's going to get hit. Even if the stop makes really good sense, it's still going to get hit. You have to trade small enough so that if the stop does get hit, you do not lose any more on that trade than you do on any other trade. For example, we have a bear trend and a low 1 bear flag, maybe a low 2 bear flag. This is a breakout, potential gap, and measured move up. It's not a terrible short, it's an okay short. This certainly is an okay short. If you want, you can call it a low 1 or a low 2. A micro double top, you can call it a low 2 selling below that bar. You get filled here. And let's say you put a stop above the top of this sell climax or above the top of the entire bear trend. Either one is reasonable. And then we got this huge bull breakout. Whether you put your stop above the top of the final bear sell climax or the entire bear trend, your stop got hit. And that's going to happen. In general, a stop is going to get hit on about 40% of trades until you become experienced. Traders who did put their stop above the top of the bear trend got stopped out over here. But if you trade small enough so that if you get stopped out, you do not lose any more on this trade than you do on any other trade, it's basically erasing your last positive winning trade and not your last 10 positive winning trades. I talked about how measured move targets can be useful in determining where a reasonable stop should be, and that's true for other support and resistance as well. Also, sometimes you'll have a reasonable setup and the signal bar is very small. It's usually a mistake to put the stop just beyond the signal bar. Small signal bars fail too often. The market goes beyond the signal bar and then again resumes in your intended direction. It's usually better to use at least a slightly wider stop. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 7th of 7 videos on protective stops. I want to talk a little bit about break-even stops. Traders use them regularly, but there's no mathematical basis for them. I also want to talk about the importance of breakout tests. The market goes your way and it comes back to the original entry price. And finally, I want to talk about stops for scalpers. Most traders should not be scalping, but everyone ends up scalping at least some of the time. The very best scalpers tend to use wide stops and scale in, but again, most traders should not be scalping. When a trader uses a break-even stop, what they mean is the market goes your way, and then you move the stop back to around the entry price. It does not have to be exactly the entry price. Maybe you make a small amount, lose a small amount, but around the entry price. If the stop gets hit, you only lose the brokerage cost and maybe a little slippage. So a small loss, sometimes a small win. Sometimes you'll have the stop a little bit better than break even. And sometimes a small win and you end up a little bit better than break even. If you have a small loss or a small win, traders refer to that as a break even trade. Let's say a trader sold here, betting on a possible trading range and a double top, and we have a small bear body here. The trade eventually goes his way. Some traders will hope for a swing trade and use the stop above the top of the bear leg. Other traders, after it goes their way, will decide that, well, it's gone far enough. I really don't want to come back to my entry price. If it does, I'll just get out break even. So they'll lower their stop from up here down to just below the low of the sell signal bar. As I said, when a trader uses the term break even or break even stop, they don't mean necessarily exactly break even. Although in general, when a person talks about a break even stop, they're talking about putting the stop exactly to their entry price. In this particular case, let's say you used an exact break even stop. You sold below the low of this bar. You got filled right here. The market went your way a little bit and you were not happy with the follow through and you decided, well, I'll get out if it gets back to my entry price. So you put a stop at your entry price and the market comes back, hits that price, and you get filled here. And all you lose is the commission or maybe a bid-ask spread or maybe a little bit of slippage. I think one of the interesting things about a break-even stop is that there is no mathematical basis for a break-even stop. The main reason for using a break-even stop is that you're confused or you're upset, and whenever that's the case, it's okay to get out for any reason, and sometimes the easiest decision is simply to put your stop at break-even. Whenever you believe your objective is no longer reasonable, it's good to get out, and if the market is very close to your entry price, sometimes traders will quickly put their stop right at break-even. The reason why there's no mathematical basis to a break-even stop is that your stop choice is not related to your entry price. It's related to the price action. It doesn't matter where you sell, above this bar, below this bar, below this bar, above this bar, below that bar, selling this close, selling down here. The stop is the same. It's above the top of the bear leg. To use a break-even stop, there's no mathematical basis to it. It's simply an emotional thing. Sometimes you're just too upset, the market's moving fast, you have to do something, you want to get out. A lot of traders just quickly move their stop to break even. And that is okay. We're people, we have feelings, we're not machines, and we take time to make decisions. If you feel like your premise is wrong, you have to get out. As I said, it's always best to select a stop based upon the price action, but a break-even stop does make sense when you're scalping, and in one other special instance, a second breakout test. A lot of times, traders will let the market come back to their entry price as long as the trend resumes, but they do not want the market to come back to their entry price a second time. If it does, it usually means the trade is no longer valid. In that particular instance, it then makes sense to exit with a break-even stop. Scalpers, a lot of times, will use break-even stops. They'll take a trade, the market goes to their profit-taking limit order price or very close to it. They do not want the market to come back to their entry price, so they'll quickly move their stop to break even. When the market gets very close to their target, then the risk is to their entry price or their original stop. It may be 4 or 5 times greater than the remaining reward. At that point, you need an extremely high probability to remain in the trade. And if you get a reversal or start to get a reversal, then the probability is no longer high, and therefore the premise is no longer valid. You have very little reward left. You have a lot of risk relative to the reward. You need a high probability, but the market is coming back against you, and therefore you do not have high probability. A lot of traders need to get out, and when the market's starting to come back, it's probably very close to the original entry price. Many traders just quickly move their stop to break even. or maybe a tick better than break even, maybe a tick worse than break even. For Forex traders, maybe a pip or two better or worse than break even. Let's say a trader sells below this bar. They can have a double top neckline hoping for a break below and a measured move down. The rally is not strong. It's probably a bull leg in a trading range. So they have a double top at the top of a trading range. Original stop, probably above the top of this bar because it's also above the double top. And you're taking a short, believing that you have a double top, which you do. And let's say you had a profit-taking limit order right here. You made some calculation that this was a good location to exit with a scalp, and the market came very, very close to your scalp, and it did not fill your order. And then it started to reverse up. What do? Some traders will exit on the reversal up or on the second reversal up. Other traders will give it time just in case we have one more push down. And a lot of those traders do not want the market to come back to their entry price. They do not want to take a loss after coming so close to a profit. They'll simply move their stop to break even, and then they'll get filled right here. If a bear is very quick, he can move his stop down to above the high of this bar or above the high of this bar and end up with a little bit of a profit. A smaller profit than what he intended to get, but better than having it come back to his break-even stop. For example, the bear might try to exit above this bar, a small double bottom, a second reversal up from below this bar. Maybe he'll buy above the high of a bull bar closing on its high and get filled here and end up with a small scalp, smaller than he intended. That's still basically a break-even trade. It's a small profit, smaller than what the scalper intended. Most traders would call that a break-even trade. Different ways to draw this. Some traders would see this as a wedge, 3 pushes down, 1, 2, 3. I know this is a small push down, but it led to a big reversal up. It's a significant bottom. And then we're also testing this prior low. You can also call it a smaller wedge here. We have a double bottom and a bear breakout. So you have 3 pushes down, 1, 2, 3. Anytime you have a double bottom and a breakout that reverses up, it's a type of wedge. And here we have a micro double bottom, down, up, down, up. It's a reasonable buy, a good looking buy signal bar. It's a reasonable swing. The channel is too tight probably for a scalp. Maybe you can get a scalp. Some traders would take this for a swing trade, betting that maybe we'll retrace 50% of the sell-off. The sell-off lacks consecutive big bear bars. It's probably a bear leg in a trading range, and we are reversing up near a potential bottom to the range. Maybe we'll get a couple legs up. Let's say we have an IOI here. He buys above the bull bar, gets filled here, and puts his stop below the low. There's a breakout, and then there's a pullback. To me, this is a breakout test. Even though it fell below the high of the signal bar, that means it fell below the entry price as well. This pullback is simply a test of the resolve of the bulls. It's testing the breakout above the high of this bar. If you're swing trading, most bulls will allow the market to come back below their entry price. They'll rely on their stop. However, once the bull trend resumes, we have another breakout, 3 consecutive bull bars. A lot of traders do not want the market to come back to their entry price a second time. If it does, they conclude the bull trend is not valid. If this pullback falls below that entry price or the signal bar high a second time, especially if it falls below this low, traders will assume that instead of a bull trend, the market is probably going to go sideways in a trading range or possibly even reverse down. We have a double top neckline. We could fall for a measured move down. This would be the break-even stop, just a little bit above the high of this bar. It's hard to see. You could say it's at the high of the bar. The market rallied the way the bulls expected. It tested the resolve of the bulls. It tested below the entry price, and it's testing again. A lot of traders will get out if it hits that entry price a second time. They assume that if the bulls are good, they'll buy heavily right above their original entry price, trying to prevent the market from coming down, hoping to get a second leg up. Therefore, some traders, if the market goes their way, falls below their entry price, and then goes their way a second time, they'll get out, break even, just above the high of that bar. The second breakout reversed up from above the top of the buy signal bar, and it formed higher low major trend reversal, a double bottom, good bull bar here, and then a good bull bar here, and it led to a swing up. Bulls will buy above the high of this doji inside bar, and especially above the high of this good-looking bull bar. This is, I would call, a perfect breakout test. It missed the break-even stop by about 1 tick or 1 pip. The bulls defended their break-even stops. They prevented the break-even stops from being hit. That is a sign of strong bulls, and it increases the chances that they'll get a swing up. So once this starts to go up, bulls are confident we'll go higher, and that's why we got this big bull bar and a follow-through bar. And the bears also gave up. This is bears giving up. They tried to get below that break-even stop, believing that if they could, the bulls would give up. Instead, it's the bears who gave up. When there's a bull trend, bulls like to put their stops below the bottom of the most recent strong leg up, below the bottom of the most recent major higher low. Here we have a biclimax, a breakout. Some bulls will put their stop here, but this is a magnet. I usually use a wider stop down at the bottom of the bull leg. It's reasonable to put your stop here. The market often comes down and tests it. Very often, in fact, it goes a tick or so below it, and then it can reverse up. Whenever you get this strong bull breakout, strong reversal, you get big up, big down, big confusion. Usually the market goes sideways and then decides whether it's going to resume up or reverse down. When you have a perfect test of the bottom of the bull breakout like this, and then a reversal up, you're probably going to get a test back up to the high. Big up, big down, big confusion, trading range likely. Bull leg in a trading range, bear leg in a trading range, probably going to be followed by another bull leg and another test of the top of the range. Bulls are trying to defend their stop. They know the bears want to break below the bottom of the final biclimax and then hope for a measured move down. The bulls hope for a test of that low, basically a double bottom. I know this is not the bottom of a sell-off like this, bottom of a sell-off, bottom of a sell-off, but it's the bottom of a bull breakout, and therefore it's a type of bottom. And if the market comes down there and reverses up again, you have a double bottom. Two different types of bottoms, the bottom of a bull breakout and the bottom of a sell-off, but it's still a type of a double bottom. Bulls place limit orders to buy just above that low and at that low, and they also place stop orders to buy the reversal up. And the same is true here. The market's coming back down to that critical price. The bulls will buy with limit orders at and just above that price, and they'll buy on a reversal up. Their concern is if it falls below, their premise of a bull trend is no longer valid. The market will either remain in a trading range, maybe falling a little bit lower, or it'll reverse into a bear trend. We have a bull trend, a bear breakout, lower high major trend reversal. The bears have a reasonable sell pattern, and the bulls are trying to prevent the market from falling below this higher low. It's also a neckline of a double top. Some bears will sell if it falls below here. You'll have the lower high major trend reversal bears happy that we're breaking below the neckline, and you'll have the double top bears selling, betting that will fall for a measured move down. If you're buying right above this low or on the reversal up, your risk is small. And that usually means the probability is small as well, and you'll get stopped out a lot. However, if you do get stopped out and there's a reversal up from below this bar, the bulls will assume that we're at the bottom of a trading range, and therefore it's reasonable to buy again if they get stopped out. Strong breakout. A lot of bulls will buy around the bottom of this breakout because the bulls bought strongly here and we rallied strongly. If we come down to that price level again, they'll look to buy again, near the price or as the market reverses up from it. Here we have a small double bottom, testing the bottom of the biclimax. Bulls will buy. Clearly disappointed by this. And the bulls who put their stop just below this low get stopped out here. But that's okay. Bad follow through on the bear breakout. Bulls will buy a reversal up, betting that instead of a bear trend, this is a bear leg in a trading range. This is a reasonable location for the bottom of the range. There was strong buying here before. Maybe bulls will buy again if the market reverses up from that bear breakout. And therefore bulls will buy on a stop above the high of this bar. They'll get filled here. Again, another breakout, bad follow through. Bulls will buy on a stop above the high of this bar, and they'll get filled right here. As long as the premise is valid, bulls will keep buying on the reversals up. Their premise at this point is that we're in our trading range, and they're buying a failed breakout below the bottom of the range. When they were buying here, their premise was that we were in a bull trend. When they bought here, they were hoping for a bull trend. But once we fell below here, I think the bulls changed and they started trading it like a trading range. Look to buy reversals up from below, looking for at least a scalp. The bears will do the opposite. When the market goes above a high, they'll assume it's a trading range now as well. Since we fell below key support, they'll look to sell at and above prior highs, betting that the breakout will fail and that will come back down. Some bulls will say, okay, it's a bull breakout, and yes, we fell below the low of the bull breakout, but we're still above the bottom of the bull trend. And instead of putting a stop just below here, they'll use a wider stop below this part of the bull leg or below the bottom of the bull trend. That's because bulls know that when you get a strong breakout, a lot of times the market comes down to the bottom of the breakout, and sometimes a little bit below, especially when the breakout is late in a bull trend. There's an increased risk that it's an exhaustion gap. For example, the gap below this low and the breakout point here probably will close at some point. It tried to close here, it did close here, and very often, I would say half the time, if you start to reverse down, you're going to get to the bottom of the bull breakout and usually a little bit below. And bulls do not want to get stopped out. They can, and they can buy again on the reversal up, but a lot of bulls instead will look at this and say, it's not really a bear trend, it looks more like a bear leg in a trading range. Bear breakout, bad follow through, a second reversal up, bear breakout, bad follow through, bear breakout, bad follow through, and therefore they rely on a wide stop and they'll buy on reversals up and scalp out. They don't want to keep getting stopped out, like buy here, stopped out, buy again here. They'll buy here and leave their stop down here, and then maybe get out here on the reversal down, basically a break-even trade. But they're hoping instead that the market went up higher and they could make a scalp, but sometimes it does not. We have a double bottom, a neckline, a strong breakout, and a perfect breakout test of the breakout point. We got a pullback from the breakout, and this is a potential measuring gap. The market's trying to resume up. Perfect breakout test of this high, so maybe we get a measured move up from either of these lows to here and then up there. We have a second breakout test, and it did not hit the breakout point. It's slightly above this high, and that's bullish. We have a decent bull bar here. The bulls defended their break-even stop, and that's a sign of strong bulls. This is a double bottom bull flag. Bull trend, a pullback to a double bottom bull flag, a decent buy bar. The problem is all of the small sideways bars, all the small dojis. This looks like it's more of a tight trading range than a bull flag, but it is a reasonable bull flag, and the bulls have a reasonable chance that the market will accelerate upward. And then trend resumption up, maybe for a measured move based upon the height of the gap between this high and this low. The second test is, I think, a really good test, perfect test. It missed the entry price. Had you bought on a stop above this high, you would have been filled a little bit above that line. This pullback hit the line. It would have triggered a break-even stop. And this pullback missed the entry price. Had you bought on a stop above this bar, you would have been filled just a little bit above this line, maybe on that close. And this high is above that close. So this is an absolutely perfect breakout test. Perfect in the sense that it got to within a tick or a pip of your entry price, but it did not hit your entry price. So it did not hit your break-even stop. That's a bullish thing. Yet the reversal up was weak. Instead of a strong bull trend, it looks like a bull leg in a trading range. A lot of traders will exit if it comes back down to their entry price again. Here it fell below this bar. Most traders would get out either below this bar or below this bar. The bulls had a pretty good double bottom bull flag after a bull trend, and they don't want it to come back down a third time, and they'll get out on a stop and get filled here, right below the low of the double bottom. The bears see this as a double top. We have a bull trend, a bear breakout, and a tight trading range. Whenever you have a double top and a tight trading range like this, and the tight trading range lasts 20 or more bars, especially if you get a decent sell signal bar, the bears have a 40% chance of a swing down, and that's what they got. The market fell for about a measured move down based upon the height of this double top. double top, there's the top of it, here's the neckline. Neckline is actually right here, but this is obviously a key price, so you could argue it's the bottom of a trading range. The bears will look for about a measured move down to take profits, and you can see they took profits here, other bears took profits here. When you're scalping, everything is important. Every little mistake can cost you money, and the stop that you use is very important. Very few traders can make a living as scalpers, and the reason is you need to take the best trades, and it's usually better if you're willing to trade fairly large, and most traders cannot do that. If you're only going for a small profit per contract, per trade, you need to have a large position if you're planning on making a living doing that. One of the fundamental problems with scalping is on most of your trades, your stop has to be further than your profit-taking limit order. Your risk is usually bigger than your reward. And that means you have to win 70, 80, or 90% of the time. There are traders who can do that, but most cannot. And you should assume that you are like most good traders and you cannot do it, or if you can do it, it's not fun to do it, and therefore it's not realistic to assume you'll be able to do that for a living year after year. Let's say a trader sold here. We have a breakout above this high, first entry, second entry. You can call it a wedge, 1, 2, 3, parabolic wedge, a decent sell signal bar. But then we get this. We got a reversal up. So now we have a double bottom and a bull bar. The trader sold below this bear bar, and he's buying above this bull bar. And then maybe he's selling here or selling there. He's not making any money. Stop entries in a tight trading range, a losing proposition. You should never do that, even if you're a scalper. Once you start to see a series of 3, 4, 5 small bars in a tight trading range with prominent tails, you should not be entering with stops. And most traders should not trade whatsoever. He sells here and maybe uses a tight stop and gets out above here. So he's losing money. He sells here, gets out above here. He buys here, he gets out, maybe below here. He sells here, he gets out above here. He sells here, he gets stopped out there. He buys here above a bull flag and he gets stopped out either below there or below here. You can see the problem. If you're scalping for a small profit and you're using a tight stop, you can easily lose a lot of money. Here we have a series of 5 scalps. All of them were losers using stop entries. As I said, whenever the market's in a tight trading range, you should not be trading, and anyone who is trading with limit orders. Using stop orders in a tight trading range is a horrible strategy. Most swing traders take occasional scalps, but you should really be focusing on swing trading. That allows you to use a reasonable stop, and you only have to be right 40% of the time because you're going for a swing, which means a reward that is at least twice as big as your risk, and that offsets the low probability. It's a profitable approach to trading. Really good scalpers can do something to increase their probability. What they do is they can use a swing stop and scale in. But as I said, most traders are not comfortable doing that. It's not fun. You have to be enjoying your job, and therefore most traders should not be thinking about scalping. It's stressful, and very few people have the personality that allows them to scalp every day, year after year. I talk about scaling in the videos on scaling in. Here we have a strong breakout above a bear channel. We have a series of 3 bull bars closing on their highs. It's reasonable to buy the close. This is a buy the close bull trend. And you know where the stop has to be. Below the bottom of the bull breakout, either below this bar or below that bar. A swing trader almost always has to use a wide stop. Sometimes he'll have a great signal bar and he can use a stop just beyond the signal bar. But more often than not, a swing trader is using a relatively wide stop. The trader can buy here, and then at the end of the session, the market's in a tight trading range, you have a bear bar, it's reasonable to exit below that bear bar, get filled here, and you made a swing profit. A lot of scalpers use wide stops, like a swing stop. For example, we have a high 2 bull flag, we have a bull trend, a high 1, and then we got a second entry here, a high 2. Ultimately, it ended up as a wedge, 3 pushes down, 1, pull back, 2, pull back, 3. this low is below that low. If you bought above this bar and you put your stop here, you lost money over here. One of the problems with scalping, especially using a stop entry in a relatively tight trading range. What some scalpers will do is use a wide stop, either below the bottom of the bull breakout or, better, below the bottom of the entire bull leg. They're not planning on having these stops be hit. They'll get out before these stops are hit. But those are catastrophic stops that protect you against some kind of catastrophe. Like if something happens in your house and you have to leave your computer for a period of time, or your electricity goes out, or your broker has problems, or problems with the exchange, you want to make sure that there's some stop that protects you against some big move against you, a low probability move, a black swan type of event. Some of these scalpers, relying on these wide stops, are looking to buy more. Here, now we have a wedge, we have a micro double bottom, and 3 reversals up, 1, 2, 3, 3 legs down, 1, 2, 3. A decent buy bar here, and a micro double bottom, reasonable to buy more here. We have a breakout and a pullback, reasonable to buy more here. The scalper is not going to buy all of these buys, especially since these are right around that price, but sometimes the scalper who buys here might buy more here or here. As the market went up, his actual risk, if he bought here, was to just below the low of this bar. The scalper does not know that his actual risk is here when he takes the trade. He knows it when the market starts to go his way. He had to risk a little bit more than from his entry price to below this low to not have been stopped out. Once the market goes his way, he then knows this is his actual risk. And this is 1 times his actual risk. He's scalping, so he's going to go for a reward that is at least as big as his minimum scalp, and he also wants it to be at least as big as his actual risk. This is a reasonable location to take profits. I talk more about this in the videos on actual risk. We have a strong bull breakout, a buy the close type of rally. It's reasonable to buy that close or this close as well. Again, stop choices below the bottom of the breakout. I usually put the stop below the bottom of the bull trend because the bottom of the breakout is a magnet and the market often comes there or a little bit below, yet then resumes up. Sometimes it breaks below and falls for a measured move down, but most of the time if it breaks below, it either goes sideways or up. Let's say a trader bought here, looking to scalp, and this did not quite reach his target, and he's disappointed by the tail here and the reversal here. He can either exit below the low of this bar and get out around break even, or he can use a swing stop either below here or down here and look to buy more if the market reverses up. He'll assume it's a bull flag and that will get a second leg up. He might buy more with a limit order at a 50% pullback of this bull breakout and he'd get filled there, or he might buy more above a bull bar and get filled above this bull bar right here, or above this bar and get filled right here. He might be so disappointed by the size of the sell-off that he's giving up on the intention of making much of a profit. He'll get out break even on his original entry and then with a tiny profit on his second entry. In general, if a trader is scalping and looking to scale in, his second entry should be at least the size of a scalp lower than his first, so that when the market comes back to his first entry, he can make a scalper's profit on his second entry. I talked about break-even stops, putting a stop to around your entry price. There's never a good mathematical basis for using them. However, sometimes emotionally it makes sense. If you're trying to get out because you think your trade is no longer valid and the market is very close to your entry price, a lot of traders will quickly move their stop to their entry price, a break-even stop. If they make a little or lose a little on that stop, they still call it a break-even stop. I also talked about breakout tests. The market goes your way and comes back to your entry price. Traders will usually allow the market to come back to their entry price once, but if the trend resumes in your direction, they do not want it to come back to your entry price a second time, because if it does, they'll question the premise of a trend. I then talked about stops for scalpers, and one of the difficulties for scalpers is that the reward usually is less than the risk, and a lot of very good profitable scalpers use wider stops like a swing stop, and they're willing to scale in to increase their probability, accepting that it increases their risk as well. One of the big problems that beginners have when they scalp is they're using stops that are too tight, or they're entering with stops in tight trading ranges, which is a horrible strategy. They're going to lose money. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 7th of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 2 videos on actual risk. I want to begin by talking a little bit about the trader's equation and what I mean by risk when I talk about risk and reward. In particular, I want to talk about actual risk in contrast to initial risk. A trader should only take a trade if he believes the probability of success times the potential reward is greater than the probability of failure times the risk. That is the trader's equation. For example, we have a bull trend, about a 50% pullback, a slightly higher low, a high 2 bull flag, one leg down, pullback, second leg down, and a decent looking buy signal bar. It's a very deep pullback. We have 4 consecutive bear bars, but it held above the bottom of the bull breakout right here and above the bottom of the bull trend right here. It's reasonable to put a stop either below the bottom of the bull breakout. If this is in fact a bull trend, the market should not fall below this low. It's also reasonable to put a stop below the bottom of the bull trend down here. Let's say you did buy above the high of this buy signal bar and you got filled right here, and you put your stop below the bottom of the bull breakout. Your risk is from your entry price, just a little bit above the high of this bar, down to your stop, which is just a little bit below the bottom of this low. This is how much you're risking initially. Different traders have different stops. Some traders might have a stop down here. Other traders might use a stop based upon money. For example, 10 or 20 pips or 10 or 20 ticks. Every trader has a different idea of where his stop should be, and therefore there's no widespread agreement on what the initial risk is. When you take this buy above the high of this bar, some traders will get out below this bar, some traders will get out below this bar, or this bar. Other traders will use money stops. There's no agreement on what the initial risk is. Each trader has his own idea of how much he's willing to risk initially. Based upon what you're willing to risk, you can come up with a reasonable profit target for the trader's equation. You need the math to support the idea that this is a good trade. You need, again, the probability of making money times the size of your profit target has to be greater than the probability of losing money times the size of your risk. Is the probability of making money 60% or higher here? It might not be. It's probably less than that. In general, if ever you are uncertain that the probability is less than 60%, you should go for a reward that is at least twice your risk. Here's your risk, the size of this brown box, just above the high of this bar, down to your stop. This is 2 times your risk. If you take this buy and put your stop down here and exit with a profit up here, the math is good. The probability certainly is better than 40%, as long as the probability of reaching this goal before hitting your stop is at least 40%, it's reasonable to exit right there. It would result in a positive trader's equation. For any reasonable trade, it's always good to exit at 2 times your risk. The math is always good. It always results in a positive trader's equation. So in general, if you're not certain where you should take profits, try to take profits at 2 times your initial risk. That always results in a positive trader's equation. For most traders, it's reasonable to exit at 2 times your initial risk. You bought above here, here's your initial risk. If you try to exit at 2 times your initial risk, the trader's equation will be positive because the probability is probably at least 40% that it'll go up here before it goes down here, given that you're buying a pullback and a bull trend. As I said, there are many choices for an initial stop, and therefore there are many possible initial risks, depending on the trader and which stop he chooses. For example, you could put a stop below the buy signal bar, below the bottom of the bull breakout, below this higher low after this breakout, or below the entire bull trend. Those are all reasonable price action stops, putting a stop based upon the price action, below prior lows, for example. Other traders will use a stop based upon a measured move. For example, the height of this sell climax, a measured move down, it should not fall below this low if you're going to have a profitable trade. Some traders will use that as a price action stop, a stop based upon a measured move. From this high to that low, measured move down, stop just below. Or from this high to that low, and a stop just below the measured move projection. Other traders like money stops, risking a certain amount of money, a certain number of ticks, a certain number of pips. For example, this might be 20 pips or 20 ticks below your entry price. All of these are reasonable stops, and different traders will use different stops, and therefore everyone has a different initial risk. The trader who bought above the high of this bar and used a stop here, that's his initial risk. The trader who has a stop below here, his initial risk is all the way down here. We have a bull breakout and a follow-through bar. Now the probability is we're going at least a little bit higher. Here we have a strong breakout. We have 5 consecutive bull bars and a close above the prior high. Once you see this or this, traders will raise their initial stop to below the most recent major high or low. Once we get a breakout to a new high, it's a bull trend as long as it remains above this low. If it falls below this low, the market then is either in a trading range or in a bear trend, in which case you don't want to be long here because you bought this based upon the premise that you're in a bull trend. All of these traders who have stops down here, once the market gets here or here, will tighten their stop to just below the low of this bar. At this point, everyone agrees where the stop should be, below the most recent major high or low. And now everyone sees how big the deepest pullback was after the entry. If you bought right here, above this buy signal bar, the deepest pullback was maybe to the low of this bar, maybe to the low of this bar. Once the market is up here, you can look back and say, where did I have to have my stop to minimize my risk and not being stopped out? Where would have been the absolute best stop on this trade in hindsight, looking back? Where is the smallest stop that I could have used and not be stopped out? You don't know that until the market has gone your way. And that brings me to the topic of actual risk. How much did you really risk on the trade? The bulls bought here above the high of this buy signal bar. You have a strong breakout here or all the way up here. At some point, you're going to raise your stop. But in any case, once you have a reasonably strong breakout, you know how much money you had to risk to stay in the trade. When the market is here, if you entered right here above this bar, the tightest stop that you could have used was right below the low of this bar. So the actual money that you risked on this trade was from your entry price to this theoretically perfect stop, which you did not know existed until the market went your way. Once the market is here and you look back, this stop is probably the tightest stop that you could have used that would have avoided you being stopped out of your trade. From your entry price to that stop just below the low of your entry bar, that is how much you actually had to risk on this trade. Your initial risk might have been here, it may have been here, it may have been here. Different traders use different stops, and therefore their initial risk was different. But every trader who bought above the high of this bar at this point knew that his actual risk was just to below the low of his entry bar. All of the traders, no matter where their original stop was, now know that they only had to risk this much in hindsight. Here we have a high 2 bull flag. We have a bull trend, high 1 bull flag, a high 2 bull flag. A reasonable initial stop is below the bottom of the bull breakout, maybe below the bottom of the bull trend. Let's say you put your initial stop here, below the bottom of the bull breakout. Then your risk was from above the high of the entry bar, where you got long, down to your stop, just below the low of that bull bar. The market pulled back, did not quite reach your stop, and then it went your way. However, once the market did this, a strong breakout above your entry price, you now have a good idea of what you actually had to risk to stay in the trade. all you had to do was risk to below the low of this bar. If your stop was just a little bit below that bar, that's all you needed to not have been stopped out. It's less than your initial risk. You did not know that this was the perfect stop until the market went your way. But once you were up here and you look back and you say, what was the smallest stop that I could have used and not have been stopped out? It's 1 tick or 1 pip below the low of this bar. So right here, this is your actual risk, your entry price to that theoretically perfect stop. Actual risk, entry price to the perfect stop. And any trader who bought here or anywhere through here, once the market is up here, he can look back and say, this is a major high or low. His actual risk was to just below that low, and it doesn't matter where he bought through here or anywhere in here. It doesn't matter where his stop was. At this point, the actual risk for any of these bulls is just below the low of this bar. You have to get out at some time, so you have to have a logical plan to take profits. As I said, there are many choices for an initial stop, which generates the initial risk, and therefore there are many possible profit targets if you're using initial risk to generate your profit target. However, once the market starts to go strongly in your direction, you know where the perfect stop had to be, and therefore you know what your actual risk was. And that's true for any trader who bought anywhere in here. His actual risk was to just below the low of this bar. The bull who bought above this bar, this is his actual risk. Computers often use actual risk to create profit targets. So for example, computers who bought above the high of this bull bar for a high 2 bull flag, if they put a stop down here initially or a stop down here, they did not get stopped out. They held long despite this pullback below their entry price. Once the market started to go their way, they would generate profit targets, many of them using actual risk. Their actual risk is the height of this blue box down to where the perfect stop was, and therefore 1 times actual risk is the top of this blue box right there. Since they're buying in a reasonably good bull trend, many of them will get out with a profit that is equal to 1 times their actual risk. It was a reasonably high probability trade when they put it on. It became lower probability after this pullback. Most traders would be happy to take at least partial profits once the market went as far as they actually had to risk on the trade. And you can see what happened when it got up to 1 times actual risk, it sold off. When it got up there again, it sold off again. That tells you that a lot of computers used actual risk to generate a profit target. Whenever you're taking a trade where the probability is high, in other words, you're fairly certain you're going to make money, the probability is at least 60%, otherwise you would not be certain, the math is always okay to go for a profit target that's equal to 1 times your actual risk. However, it's always good to go for 2 times your actual risk. Sometimes it's unrealistic. If you bought here and you were disappointed by the size of this pullback, a lot of traders would simply try to exit at 1 times actual risk. On any trade, the math is always good to go for a profit of 2 times actual risk. Here we have profit taking at 1 times the actual risk, and that tells you that computers are taking profits there, and they took them again up here. And that tells you that exiting at 1 times actual risk in a high probability trade is a reasonable thing to do. Profit targets lead to pullbacks, and therefore they are resistance in a bull trend. When the bulls take profits, the bulls are selling, the bears are always selling. The bears know where the profit targets are as well, and they'll sell up here as well. In a bear trend, where you take profits in a bear trend creates support. The bears buy back their shorts. The bulls know where the bears are buying back their shorts, and the bulls buy there as well. You usually get some kind of a bounce. The bulls take profits here. The bears know the bulls will take profits there, so some traders will sell for a scalp at that profit-taking location for the bulls. Some of the bulls who bought here will buy more lower above a bull bar, so they'll add to their position right here. As long as they believe that the market is still always in long in a bull trend and that it will go higher, they'll continue to add on lower, especially above bull bars, as long as the second entry is at least the size of a scalp below the first entry. Many traders who bought here and bought more here, as long as the second entry is at least the size of a scalp below the first, they'll take profits when the market gets back to their first entry. They get out break even at their first entry and then with a scalp on their second entry. And you can see the hesitation when the market got back to their first entry price. When you look at any chart, 90% of the bars are in a channel or a trading range, and that means the probability is not especially high, and therefore a reasonable minimal reward is always 2 times actual risk. If the actual risk is too small, a lot of traders will go for a reward that is 2 times initial risk. 2 times actual risk always results in a positive trader's equation, and since initial risk is almost always at least as big as actual risk, if you go for 2 times initial risk, that will also always result in a positive trader's equation. Let's say a trader saw a bull trend, a 50% pullback, and they bought above the high of this bull bar. Their idea is either it's a pullback in a bull trend or a pullback in a trading range. Maybe the market will simply go up to that high and go sideways. In either case, it's a reasonable buy. And let's say he puts a stop just below the low of his buy signal bar. Then his initial risk is from his entry price here to his stop just below his buy signal bar there. As I said, the math is always good to take profits at 2 times actual risk or 2 times initial risk. Here's 1 times initial risk right here, and here's 2 times initial risk right here. Therefore, it's mathematically reasonable to take partial or full profits here if you bought there and put a stop here below your buy signal bar. We have a breakout here, a pullback, and a strong buy climax. If you're buying this close, you need a wide stop, either below the buy climax bottom or below the bottom of the bull trend. Let's say you buy that close and you're disappointed by this, but your premise of a bull trend is still valid in your mind and you rely on your stop. The market starts to go your way. Actual risk is from your entry price, which is buying this close, to just below the low of the pullback. This is the size of your actual risk. You bought a strong bull breakout, 60% chance you'll get a move up that is at least as big as your actual risk. This is your target up here. Here's your actual risk from your entry price to your stop. That's how much you actually had to risk. This is a reasonable target, 1 times your actual risk in a high probability buy. Yet we have a double top here. The bulls tried to get to that target here and failed. They tried strongly to get to that target and failed again. What do? I would exit longs. Since the bulls twice tried to get to their target and were unable to get there, and we have 2 decent bear bars, the market traded below, and if the market goes below here again a second time, it's a second entry sell, maybe for a wedge. 1 reversal down, 2 reversals down, 3 reversals down, and now a second entry. It's reasonable to get out here, even though the market did not reach your target. Your premise is no longer valid. You bought what you thought was a bull trend, and now we have a wedge top or a double top. I began talking about the trader's equation and risk. There are actually 2 kinds of risk. Initial risk, the distance to your stop. Everyone has a different stop location, and therefore everyone has a different initial risk. Once you're in a trade and the market strongly goes your way, you can look back and find out where the perfect stop had to be. Where would you have had to have a stop so that you would not get stopped out? That is your actual risk, from your entry price to the perfect stop. I'm Al Brooks. This is the first of 2 videos on actual risk. Thank you for watching the Brooks Trading Course.